And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Man, lots of news headlines overnight going on right now. Of course, the port strike is now officially started today. That could cost the U.S. up to $5 billion a day, theoretically, in GDP. But 45,000 workers now dock workers on strike all the way from Maine all the way down to Texas. That's going to certainly provide some impact. And interestingly enough, the Teamsters Union has told Biden to stay out of it. They don't want any input. And it's kind of interesting because he's such a big union supporter, right? So it seemed like you'd want his input, but they're like, stay out, this is our thing. So, this is going to be very interesting to kind of watch what the impact is on the economy. It's not going to be a huge, this will get resolved, it'll go away. So this isn't one of those things where you go like, oh my gosh, you got to sell everything and go run in the weeds. It's not going to cause a recession. Nothing like that. But anyway, it is going on. Outside of that, Israel has now launched a ground offensive. That's going to obviously kind of spark up geopolitical risk, particularly for the markets and oil prices, which have been under a lot of pressure lately. But we'll keep a watch on what's happening with that. Famous people dying overnight as well. Kris Kristofferson, Pete Rose. And then Jimmy Carter turned 100 today. I told Brant this morning, I didn't even know Jimmy Carter was still alive, but he turned 100 today. The guy's out there building houses, for gosh sake. So, lots of headlines, lots of stuff going on.
Still being useful.
Still being useful. And yeah, but, I really think he got a lot of blame for stuff that wasn't his fault.
Yep.
So, everybody's like, oh, Jimmy Carter was the worst president ever. No, we've had worse.
His spirit animal is the scapegoat.
Yeah, I think that's about right. So, he did get hit with a lot of inflation. That was unfortunately under his watch, but it didn't have a lot to do with him personally, but he got the blame for it. All right, so let's talk about the other stuff that's going on. Kicking off earnings season, we are now finishing up. We finished up September yesterday. Today's the first day of October. Importantly, we've had a very strong first 3 quarters of the year. In fact, since going back to 1950, this is the strongest year of a presidential election year in terms of returns through the first 9 months ever on record. We're up 20%. It's the strongest year ever in the first 3 months for gains in a presidential election year going all the way back to the 1950s. It has been a very good year. And what's interesting is everybody's been talking about AI and the AI stocks, et cetera. And there's some have had some big runs. But it's not been just AI, right? Apple's up 13% for the year. Microsoft's up like 15% for the year. Costco is up 54% for the year. Walmart's up 40% this year. There's been these very quiet sleeper stocks in the background that have done exceptionally well this year. And again, as we've talked about before, breadth has improved a good bit. And that's been lifting up a lot of other sectors of the markets. But, this is despite, and we're going to talk a little bit about this morning. I kind of teased our conversation yesterday a bit that we'd be getting more into details, but I've got a lot of charts and stuff to share with you this morning. Talking about this massive inflow of monies and kind of into the market. So really, despite whatever your thesis is, and I thought it was interesting that I see a lot of kind of very negative commentary on the markets, like crashes are coming, recessions here, etc. But yeah, the markets just kind of keep climbing as we go through the year. Markets up already over 20% this year so far, just in the first 9 months. So we'll see what happens. But look, there's always risk of a correction. Absolutely. Things should always pull back. And in fact, at this point right now, it would be healthy. Markets are up over the last 42 weeks. Markets have had a huge number. 38 weeks out of the last 42 have been positive. 32 of the last 48 weeks, I'll get that number right, have been positive. And that's a very, very big run in the markets, right? So it's just not surprising that you've got good gains this year. It's just been a very positive return. And this is all despite, concerns about recessions, concerns about, debts and deficits and all these other things. But it's not been just stocks. It's been gold. It's been Bitcoin. That's kind of an interesting thing here as well, is that Bitcoin has had a very nice run this year so far and has been doing well. But yet retail interest in Bitcoin, we had this very big surge. But retail interest in Bitcoin has really fallen off. I used to get all kinds of people texting me about Bitcoin. They had like laser eyes and stuff. No laser eyes. I don't know what's going on. But it's just really been an everything market this year. Bitcoin's up 54% for the year. The market's up 20. Gold is up, like 26. So it's just been a phenomenal year where all asset classes are rising. And again, that's a good thing, but it really kind of shows you how much money is just really kind of piling into the markets. But let's talk about what you need to know before the bell this morning. So yesterday, the markets were kind of trading in negative territory for most of the day. Then right at the end of the day, we had a bunch of institutions come in and buy up for the end of the quarter, and we actually finished the day positive. But on a short-term basis, again, the markets are, just functionally just a bit extended. And we've seen these before. Every time markets kind of get extended well above the kind of the running moving averages, etc., they tend to kind of stall, and then you get a bit of a correction, and then you kind of get the next advance. And we're kind of in that space right now. Markets are fairly well deviated from their 100-day moving average, as we've seen previously. And again, as we talked about before, is just when you get these kind of deviations from moving averages, they're like gravity. They kind of want to pull prices back at some point. Markets are very overbought. Now, we're not on a sell signal yet, but again, we're going to probably see one here sooner than later. I wouldn't surprise me over the next couple of weeks, particularly as we move into earnings season, get a little bit of sell-off, and particularly here, again, as we talked about before, right before the election, get a little bit of a correction. That'll kind of set markets up, for a rally into year end. Again, I wouldn't expect anything major here in terms of a correction, maybe a 3 to 5% correction to something to kind of bring you back towards those moving averages, retest support. Would be a healthy pullback. Work off also some of this more extended kind of overbought condition. So again, markets on a relative strength basis are overbought. On a momentum basis, we're getting pretty extended. Prices are fairly deviated above moving averages. And again, there's nothing bearish about that. That's all very positive, but they can't stay that way forever. So again, you're going to get some type of corrective action. I would kind of expect that over the next 30 days. That sets you up then for kind of that year-end rally, as there's going to be a lot of managers trying to play catch-up this year. They're behind in performance. They're going to have to play catch-up. And then more importantly, stock buybacks will return at the end of the month. But anyway, so just that's kind of the thing to kind of be looking at here in particular. Also, interest rates, as we talked about before, bond prices had gotten very, very extended. Kind of really across the board, and that is something that has we talked about. It was kind of too late to buy a bond position at that point because things had gotten very extended, very overbought. This is interest rates, so this is the inverse of bond prices, but those have actually come up. We're starting to challenge the 50-day moving average from underneath. That's going to that's kind of working us into a position to where interest rates are now moving back up and overbought, meaning bonds are getting oversold finally. So we're likely going to get a little bit better setup here. Not just yet, but I would suspect maybe over the next month or so, particularly if we get a little bit of a correction in the markets, that we might get a little bit better setup here to add to bond positions. Now, last week we did start extending some of our duration. We moved a lot of our very short-term money, our 1 to 3 year kind of T-bill and chill money. We moved that to 3 to 5 year bills. So we've kind of started doing a little bit of shifting to add duration to the portfolio. But before we kind of make long duration bets, we needed this corrective process to occur that we're in. We talked about that previously. But now we're in the middle of that corrective process, and that may have a little bit more to go here. But that's what you need to know before the bell this morning. So when we come back, we'll pick up with John Penn. We're going to talk a little bit about markets and kind of this massive inflow of money and where it's coming from and where it's going to and what it all means. So all that's coming up next on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. There's not enough coffee in the world right now.
There's not.
I did not sleep well at all last night. So,
I need one of those hats that you see at the ballpark with like koozie cups on each side, but coffee on each side, just with a drip right into my mouth. How about that image this morning?
I'm totally with you. You know, but I'm drinking this coffee. I've complained before that the coffee is just terrible. But I've come up with, I have a conspiracy theory about coffee, especially like K-Cups and coffee pods. You know, they come in all these different boxes with different flavors. You know what? I think after drinking so many different varieties, and like we have a variety pack that comes to our office. So in our office, you have all these different blends, right? It's like the Caribou blend, the Dark Magic blend, this blend, that blend. I think it's all the same bag of coffee that they just put in different K-Cups and labels because it all tastes the same, right? People, you know, it's like snooty people. It's like when they're drinking wine, they're like, oh, yes, that's a vintage of, you know, I think that's complete BS. I think they're making that stuff up. And I think people that go, oh, yeah, I can tell the difference between coffees. I think you're completely full of BS. I think it's all this. I think there's one big bag of coffee somewhere that everybody's buying out of, and that's it.
They just put different labels on
Exactly.
it. And you see the name. You're like, oh, this does taste like a blueberry muffin.
I think it's all psychological. I think it's all the same coffee.
Come to think of it, it does taste like a banana muffin. Huh. It tastes awful.
That's just my conspiracy theory. A new study has come out showing that people who take their coffee black are more likely to exhibit psychopathic traits. And people who order a quad shot, non-fat, vanilla soy, extra foam, light whip with caramel drizzle are more likely to be their victims. Absolutely agree with that statement.
I agree.
I can't. Don't argue with me. It's the study. That's what the study said. So, SEC Chairman Gensler came out yesterday, and I thought this was, you almost have to laugh at headlines. He comes out and says, "We're going to crack down on insider trading." Great. Can we start with Congress?
Ooh. Yeah.
I mean, you don't have to look far, right? You don't have to work too. I know, Gary, that being the SEC chairman is a tough job, and rooting out the evildoers of insider trading is probably a challenging job, but you don't have to go far from your office. They're right there in D.C.
So you just kind of need to clean your own house first is what I'm hearing.
Amazing how that would work. All right. Exactly. All right. Let's talk a little bit about the everything market, because that's kind of what we're in right now. And the question is how much longer can an everything market go on? I have a chart here. I thought this was interesting. I'll explain. Don't worry if you're driving. It's fine. I'm going to explain it to you. But this is a chart of just asset returns in a whole variety of different asset classes just since August the 5th, right? So the S&P's up 10.5%, equal weighted S&P's up 9.4%, Russell 2000, so forth and so on. China's up, well, at this time, when I actually pulled this chart, China was up 16. It's up like 30 now. So I mean, it's just been on fire. But it's just been an absolutely amazing year. And look, and again, equities, bonds, gold, Bitcoin, it is literally an everything market. Literally everything is going up at the same time. And it doesn't really matter if you own junk bonds, they're going up. If you own treasury bonds, they're going up in price. So it's just, and of course, all different rates of increases, but everything is going up. Well, in order to have an increase, in an asset, you've got to have more buyers than sellers, right? We talked a little bit about this yesterday. And what's interesting is that, whether it's the commentary about, stocks are going up because of earnings growth or whatever it is. Gold's going up because of debts and deficits. And I thought this, and that's a very interesting argument, because actually the deficit as a percentage of GDP is declining. And gold is going up. Normally when debt and deficits as a percentage of GDP is declining, normally gold prices reverse, right? Because they went up as the deficits were expanding. And now we're having this reduction in debts and deficits as a percentage of GDP, because we have very strong GDP growth right now, higher than normal trends. But yet gold's still going up. So again, it's no matter what your narrative is, it really hasn't mattered too much, because the underlying premises of things, and again, you can almost be guaranteed. I can come up with a thesis that says, well, stocks are going up because the moon's made out of cheese. And you can't argue that because asset prices are going up. And obviously my thesis is correct because asset prices are going up, right? So I can come up with all these kind of different rationalizations and reasons for why asset prices are going up. But in reality, this comes down to just, a function of flows. And what we're talking about in particular is money supply, and not just money supply in terms of central banks, but we've seen sharp upticks in, again, the global money supply, and not just from the United States, but we've had a very sharp increase, $7.3 trillion this year increase in the global money supply. And, so just a massive flood of liquidity is coming in. It's got to go somewhere. So it's and particularly it's not just in particular it's not just central banks that are fueling the asset run in the markets. Again, you have a tremendous amount of assets that are held in mutual funds and retail investors piling money into ETFs and pension funds and mutual funds and private foundations and, university endowment funds, and all that money has to go somewhere. And when markets are rising, it drags more and more money into the market because they've got to keep up with returns. All these institutions are performance based. If they're not participating in markets, then they lose assets. Because they're whoever funded the endowment or whoever funded the pension, et cetera. I'm going to get a different pension manager, and everybody gets fired. So, money increases or price increases drag more money into the market, which causes prices to go up more. So it's a this kind of the self-fulfilling feeding frenzy that just goes on as prices rise. Here's a chart of interesting. This is flows. And Brent's a little off kilter here. 1 second. He'll Sorry. But you got it? Okay. But I didn't know you were set on that one. I hadn't enlarged it yet. So there you go. But this is a chart of money flows. And what it shows you is this goes back to 2014. Or actually 2013. So in 2013, 14, 15, 16, 17, this just shows how much money flow was coming into the markets. 2024 is on pace to be the second strongest of the year, or the second strongest year since 2013, outside of 2021. Now, mind you, what was going on in 2021, right? That was where we had zero interest rates. The Fed was doing $100 billion a quarter or a month in QE. You had stimulus checks being sent to households. You had money being printed out of the government, and just a whole. I mean, there was just money. Literally, you had the PPP programs. You had everything else. You had moratoriums on everything. Mortgages, college student loans, etc. So everybody had a lot of excess capital that went into the financial market. So the fact that this year, 2024, is on pace to be the second strongest since that year is pretty incredible. And again, we don't have, well, at least we don't think we have, all these other programs. But there's a tremendous amount of flow coming into markets, which is driving asset prices up across. And again, as we talked about before, and we discussed this a little bit yesterday, just from the very basic premise of how markets work. For every buyer, there has to be a seller. And the only difference is what happens between the buyer and the seller. In other words, as we noted, sellers live higher, right? So they're constantly selling at a higher price, and because a buyer is having to pay up to bring that seller into the market, well, consequently, the higher prices go, the higher prices have to be in order to bring us, because I don't want to sell. Right now, I don't want to sell any assets, right? Because they're going up, right? You own gold. Will you sell your gold right now? No, because prices are going up. Will you sell your stocks right now? No, because prices are going up. I don't want to miss out, right? But there's a price. If I came to you today and I said, hey, will you sell me, your NVIDIA stock at 150, right? Some number higher than where it's currently trading, or will you sell me your gold at, $3,000? There's a price where you say, yeah, I'll take that because it's higher than the market, right? And so, but that drags the price up. And that's what's happening in the markets every day, is that buyers, are having to bid up the prices in order to get somebody to sell to them. And this continues to drag those prices higher. Here's a chart for you. This is the aggregate financial allocation to equities, debt, and cash, right? This is financial asset allocation across households, mutual funds, pension funds, foreign investors, highest level since 1990. Everybody is in the market. So whatever you think your thesis is that's driving markets higher, that ain't it. It's money flow. And there is so much money chasing so few assets right now, it's driving every asset price through the roof. It is literally the everything market. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I grew up in this little bitty town called Lake Jackson. This town was so boring. They named the streets this way, that way, circle way, anyway, and which way.
The Real Investment Show podcast.
There wasn't a lot to do. So on a weekend, everybody would kind of get together and they would drive to Pearland to the flea market. The whole fun of it was trying to negotiate so you could leave with somebody else's piece of crap that nobody wanted. And you say, I got a hell of a deal on this thing. I chewed the guy down to $8 on this rusted wheelbarrow that I bought.
At realinvestmentadvice.com.
I'm going to go home and spend $30 fixing it up. But hey, I got it. Cheap.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. John Penn joining me this morning.
Morning.
So just kind of talking a little bit about this everything market. And what brought this up was kind of a couple of different articles. There was an article out on Market Watch, and they had interviewed John Paulson, who's always bullish. Jim Paulson. He's the ever always bullish guy, right? So it's like when markets are going up, they're always going up, and when markets are going down, they're always going to go up. He just made a comment. He's like, this is a cocktail of full support at the front and the end of a bull market, which commonly creates an everything market during an early part of a new bull. So, he's convinced like we're moving into a new bull where everything is going to go up. Conversely, right, there's people making very bearish comments saying that, this is the last phase of a market melt up and this is where everything blows up and dies, right? So, but again, it's all about money flows. And as I was talking about, a few minutes ago, there are certainly some things, worth considering, technically, fundamentally, et cetera. And there's just, as I said, John, there's just so many assets, right now, dollars, right? Just chasing so few assets that are out there at the moment.
Well, that was a great point that you brought up. So can provide a little context around that if you can. So talking about too many dollars chasing too few assets. So just look at like a stat around the total stock market index and the number of companies that are trading publicly currently. Yeah. Right.
Well, and again, all these charts, by the way, if you go to the website, realinvestmentadvice.com, if you want to read the article for yourself, it's on the website this morning. It's called The Everything Market. But yeah, I have a chart of this is the number of U.S. publicly listed companies going back to 1996 to today. And this is what I mean by chasing, too much money chasing too few assets. You had over 8,000 publicly traded companies in 1996. Today, you have about 4,300. So you've pretty much cut the entire, and this is because of bankruptcies. A lot of companies went bankrupt in the 2000 mergers, leveraged buyouts, companies going private, etc. That has just been one of the big issues. Consequently, it's not just that we have fewer assets in that. Gold production is an example. And again, it doesn't matter kind of what asset we're talking about. Brent, can you bring this chart up for me? It doesn't really matter what asset you're talking about. There's been less production in most of the assets. But mining production in gold has actually declined over the course of the last several years. So again, more money. As prices of gold go up, people want to, it's like, oh my gosh, I'm missing it. I got to get in. I got to go buy it. And there's less gold production out there to support the demand in the market. So that causes prices to rise. Not surprising. But again, this is how these markets kind of work. And again, we can come up with great rationalizations. The market's going up today because John Penn is in the studio. And that's hard to argue because the market's going up. And again, this is the problem with having a thesis. My thesis is that the reason A is happening is because of B. That's fine, but you can't disprove it because right now it's working. So it's like, okay, well, I guess that thesis is right because the price of this is going up because of that. But in reality, it has nothing to do with the thesis. It has everything to do with the flows of assets.
Yeah, and I mean, just as you're building the case for, hey, here's the thesis why, I have a thesis why the market continues to rise, and you're talking about flows, right? Mm-hmm. I mean, I can't tell you still how many individuals and families I visit with where they have a thesis on why not to invest.
Right.
They find every single reason why they shouldn't invest. And I'm glad that you covered the port closings or the strikes or the ports this morning.
Right.
Because
that's going to be a thesis.
Because that's going to be a thesis. When you look at CNBC, I mean, it's right there in big, I don't know what the biggest font they can put that in, and it's right there in your face, right? And you start reading through, and you start reading a couple paragraphs into the article, and it's like, well, this will be a devastating blow to the economy. This will be a crushing blow to the economy. Okay. But let's take a look. Let's just take a step back and think about it here. Okay, could it cause a blip on the radar screen? Maybe.
Yeah.
It might.
Yeah.
But is this a reason for you to say, well, I'm just not going to invest for the longer term. I'm going to get down into like you said, get into the weeds or get into the bunker, right? Mm-hmm. It's easy to get that mindset, I think.
Yep. No, and look, and there are things to be concerned about. I don't want you to walk away from this conversation this morning thinking that, oh, Lance is just bullish and stocks are only going to go up from here. That's not the case. There is certainly some risk that's playing out here in terms of when you have an everything bubble, and when you have an everything market, they don't last forever. And the reason is that at some point somebody says, okay, this is enough. I want out. And then you kind of reverse this process. Let me show you this chart here. This is a very important chart. Historically, gold should have, as an example, gold is considered a hedge against volatility and risk. So gold should have a negative correlation to stock prices, right? So when stock prices are going up, gold should be going down. And that is normally the case historically. There's been a negative correlation, except in a few situations along the way, gold would rise along with the markets. Currently, that correlation, and this is the whole point, is that if you take, there's so many different asset classes, and it's the same across asset classes. If I do stocks versus emerging markets right now, if I do bonds versus stocks, you'll see rising correlations across the board. So, but just gold should have a negative correlation in theory because it's a hedge against volatility. If stocks are selling off, people want to be in gold for safety, right? It's like, oh, it's a bear market. I want to be in gold, and that makes complete sense. The correlation right now between stocks and gold is almost 1. So in other words, stock prices are going up, gold prices are going up. Again, this is what I was talking about before, is that everything is going up at the same time. Now, here's 2 very important charts that I just want to show you really quick. These are monthly charts. This is the S&P 500 going back 50 years. There have only been a few occasions on record. In fact, you can count them up here, 6, previous to this, where the market has been this overbought, this extended, this deviated from long-term monthly moving averages. You're currently trading 4 standard deviations above a very long-term moving average. You're going to have a correction at some point, but this is a monthly chart. And as we talked about the other day about monthly charts, these can take much longer to play out. This could be another 6 months or another year. But the deviation from long-term extremes or long-term moving averages, medians, is getting extreme. And those are unsustainable. Now, same chart. Same exact setup of the chart. This is gold. 4 standard deviations above long-term moving averages, only 5 periods previously where you had these types of deviations in gold prices, right? So the issue with an everything market, and again, I don't want you to walk away from today's conversation going, oh, everything's fine, just go throw all your money in the market. No, you've got to manage risk. And you need to understand that markets are extremely deviated from long-term means. They are eventually going to correct back to that mean. And the last time that we were talking about this was back in 2019, and then we had the 2020 correction. But we were writing articles called This Is Nuts. If you go Google our website and say, Lance Roberts, This Is Nuts, you're going to see several articles talking in 2019 talking about how this market was nuts at the time, and then we had that correction. But again, it took quite a few months before that correction played out. Now everybody goes, oh, well, it was the pandemic. Well, it doesn't matter what the reasoning is, right? If the sports strike, as an example, matures into some nationwide strike and shuts down the economy, the market's going to correct. And everybody's like, well, you couldn't have seen that coming. Technicals are telling you that there is risk to the markets because the rubber band is stretched so tightly that all it takes is some event that causes an unwind, right? We don't know what it is, don't know what that exogenous event is. But we'll all blame that event. Well, if it hadn't been for that, the markets wouldn't have corrected. No, the markets are going to correct at some point. Could be a year from now. But they're going to correct because of those extensions, those deviations. And that's our job as managers, is to navigate that risk.
Yes, I kind of think about it this way. When you're looking out there on the horizon in the near term, and kind of the clouds of risk are starting to get a little thicker, maybe a little bit more dense, it's okay. Hey, take an active approach and, step in and maybe take a little risk off the table. Raise a little cash, take some profits, take some of that fruit that's been grown on the tree and take some of that out and put it in the basket off to the side, right? But then as those clouds of risk out there start to get a little thinner, maybe see the sun starting to peek through a little bit, okay, well, maybe it makes sense to maybe add a little bit more exposure. So you want to take a kind of a proactive approach with this versus an all or nothing, where there are still folks I visit with that got out in 2008. And they've been out ever since, just waiting. And it's there's always risk out there when it comes to investing. Always. There's never I don't know, is there ever a perfect market?
Right now, it's perfect.
It's perfect
now?
It's perfect
at the moment, yes. Because again, it doesn't matter what you invest in. See, everybody's a genius right now, right? Because no matter what you invest in, it's going up. So whether it's stocks or Bitcoin or emerging markets or China, you're killing it, and that's great. I am whatever you're invested in, that's awesome. Congratulations, you're making money. Just understand that there is going to be a point, and as we talked about before, just don't forget to take profits.
That's it,
right? Just don't forget to take an unrealized gain is not the same thing as a realized gain. Don't forget to take profits. And that doesn't mean sell everything. That doesn't mean sell everything you own and go to cash. That's not what that means. It just means put a little bit of money in the bank. And then when things do correct at some point, and they will because that's how markets work, take that money that you put aside and put it back in the market, right? It seems easy.
Should be.
But just be cautious. We are definitely in an everything market. It's all good. For now. Be right back after the break. Wrap up the show with John Penn. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Be sure and like our, if you're watching the YouTube channel this morning, please hit the like button. As we talked about before, that helps push the algorithms for Google, gets our video out there so more people can see it. We certainly appreciate the help. It helps us a lot if you can just click the like button. I know it's a lot to ask, but we'd appreciate it.
Otherwise, hey, good morning, everybody in our chat. Come on,
yeah,
give us some love. Hit that like button.
There's 624 people in chat right now. So, watching the live stream. So, click the like button. We should have 600 people, 600 likes.
Just nice to know that they like us. They really like us.
Exactly. And if not, I'm going to put it all behind a paywall. So either you like it for free, or I put it behind a paywall. So there you go. Mm-hmm. I'm going to try a mild threat, see if that works a bit. All right, John. I've dominated your time this morning. I apologize.
Man, I not at all. This is really good stuff. I'll tell you now that with here's a very common question that I'm getting, or a concern really, especially now that the Fed has started to reduce interest rates, right? So he just reduced rates by 50 basis points, or 0.5%. Looks like there's maybe some smaller rate cuts in store before the end of the year, 2 more Fed meetings. So folks have been sitting in money market or short-term T-bill and chill, right? Either money markets, T-bill and chill, but now they're starting to see these rates come down. So they almost feel compelled, like they need to start searching elsewhere for other sources of yield, whether those are dividend-paying companies or what have you. But the challenge that they're running into is that some of the more defensive companies, those that pay dividend yields, have already had a pretty nice run up in price. And you mentioned some of those earlier in your previous commentary, like Costco, Walmart.
Yep.
Look at Procter and Gamble.
Yep.
Look at Duke Energy.
Yeah.
I mean, you look at, just for the yield on that is just shy of 4%. But just this year, I think Duke is up 22, 23%.
Yeah. Well, you remember we added Duke. We've owned Duke for a while, but we added to Duke. In the dividend equity model, we added American Electric Power.
Yeah.
GE Vernova. Which is up 50%. Yeah. So, it's just, and then this is the problem. Now, GE doesn't pay a dividend. GE Vernova was a bet on the AI demand for energy.
Yeah.
So, but the utility companies pay that. We also added real estate companies to the dividend equity model earlier this year. Nobody wanted those stocks back then, but they were all yielding 4, 5, 6, 7%, right? Nobody wanted them at that time. now everybody wants them. And this is always the challenge. And particularly, this is the challenge, right, when you talk about an everything market, is because no matter where you put money, there's no safe place. And what I mean by that is that when you have a correlation nearing 1 between all asset classes, in other words, everything's going up at the same time. When somebody, and again, remember, as we said earlier, the market's about buyers and sellers. It's just a market. So for every buyer, there has to be a seller. This seems logical, but people forget that this is how markets work. Somebody has to be selling. Somebody has to be buying. They both think they're right. But the problem is that when there's a correlation of 1 on every asset class and somebody says, okay, I'm out, where are you going to go, right? You can't go from, growth to value because value's already had a huge run. You can't go from, large cap to mid cap because it's already had a huge run. So there's nowhere to go other than cash. So this is where it becomes really challenging. You kind of almost put yourself in a position of jumping from the frying pan into the fire. Right.
And I think so. You're talking about buyers and sellers, and it is a market. And I think some of that might get lost a little bit because now we're so used to logging into our accounts, no matter where your accounts are held, at any of the custodians now, whether if it's Schwab or Fidelity, E-Trade, Vanguard, what have you. Mm-hmm. And when you press that buy button, you don't see, quote unquote, if you're buying, you don't, quote unquote, see the seller on the other side. If you're selling, you don't see the buyer on the other side. And your trade just goes through, right? I mean, it's so automatic, it's so automated. But there's another person on the other side of that is entering on the opposite side of that transaction, at least for now, right?
No, that's right.
Yeah.
And again, this is where risk management comes in so importantly. Yeah. And again, this is, as I was saying earlier, it's not about selling everything you own. It's not about going to 100% cash. It's not that. Because, the problem for, people in money market, we've had a lot of people just sitting out of the market. It's like, why be in the market? I'm making 5% on my money market account. It's great. Okay, that's great. You got 5% on your money market with no risk. The market's up 20, seemingly no risk because it just goes up every day. But the problem is that the money market yield's going away.
Right.
So now where are you going to go?
Yeah.
Right. T-bill and chill is starting to fail because, or I shouldn't say fail, but those yields on T-bill and chill. So if I'm just rolling T-bills, that was working great. I was getting 5%, but now that number is going to be less as the Fed cuts rates. And if the Fed does cut rates further, then that's going to continue to erode that kind of safety hole that you could kind of run into.
Yeah.
Right.
And I think and you've mentioned on a couple of times just this morning about it's all about managing risk. This doesn't need to be an all or nothing bet with your portfolio here, mm-hmm. right? And knowing what your risk tolerance is, just how important is that? Just what kind of investor are you? Just what is your risk tolerance? What is the return that you need your money to earn? And you can't allow these headlines and everything that all of these websites are hitting you with the face in the morning. The port shut down and Fed's lowering rates, and oh my gosh, are we going to be in a recession in 2025 or not? I mean, you can't allow these headlines to allow you to make these knee-jerk reactions, which could be devastating to you and your overall financial success. Not only in the near term, but also for the longer term. Not just for you, but also your family and your loved ones, right? And so it's you got to remember that, hey, it's great to pay. Yes, are there risks out there? Absolutely. And do we pay attention to them? Do we follow them? Do we monitor them? Yes. But you can't allow them to derail you, and that's where this working with your money, it's so emotional, mm-hmm. right? And just as people, that's just how we're wired, right?
No, that's right. And this is the challenge.
Yeah.
We spend a lot of time talking about psychology
mm-hmm.
and behaviors, and really this whole conversation today that we're having with you just comes down to your personal psychology and your personal behavior. And again, no matter what you invest in, no matter how you want to invest, that's you, right? And you do you, and I'll do me, and we're all going to be in markets, and that's how markets work, right? I mean, you're investing a certain way. For instance, somebody made a comment that their tobacco stocks have been doing well for them, and that's absolutely the true case. Tobacco stocks have done very well. They have a high dividend yield. We owned Philip Morris as an example in our dividend equity model. That stock had a huge run. Mm-hmm. About a month ago, we sold that position, took those gains because it was so extended beyond its norms
that it was going to correct, and it's had a little bit of a correction since then. Now it's working its way back to its moving average. It's working off that oversold condition or overbought condition, and now we're probably going to get another opportunity to buy it back and put it in the portfolio. So, that's just the management side, right? But again, as our psychology is that when something's going up, it's like, I can't sell it. It might go up higher. That's the part you've got to get over. And when something's going down, you can't say, well, I don't want to sell it because it may go up, right? If I get back to even, that's the huge trap, right? As soon as I get back to even, I'll sell it and get out of it. No, you won't. Because when it does go back up, you're going to say, well, maybe it'll go a little bit more, right? And so you don't sell it, and then it goes back down again. That's why managing risk will help you survive look, the market's going to go up more often than it goes down. So just understand that right up front. If you just put your money into an S&P and ETF, odds are you're going to make money 73% of the time. You've got to worry about the 27% of the time that you don't. But you can navigate that risk by managing your portfolio.
Yeah, and you got to think about as an investor, and I know I've said this before, we're all happy when we see green on the screen and we look at our positions page and we look at our gain loss and everything's green and that we feel good, right? But as soon as we have a little bit of market volatility, oh my gosh, what am I doing? Did I make a mistake? Look at the middle of July through the beginning of August when you had that whole yen carry trade and that ordeal. Yeah. At that period of time, the market was down. S&P was down 8.4.
Yeah,
NASDAQ was down 13. Yep. In any given year, and you've made this comment a number of times. In any given year, a market move up or down of 5 or 10%, up or down, that's
completely normal.
That's normal.
Now,
right?
20% to the upside is a little bit abnormal, but
Young Frankenstein, Abby normal.
That
just came to my mind. Again, I need more coffee. Sorry.
Yeah, but that's one of the great. Honestly, that is one of the greatest movies ever written by Gene Wilder. And he actually wrote that movie while he was making another movie, and he wrote Young Frankenstein while he was making another movie, and he was writing it in his trailer while he was making the other movie.
Fantastic. Sorry, guys. I just derailed the show right there. There it was.
No. I mean,
Young Frankenstein.
we're finishing up the show, but if y'all have never seen Young Frankenstein, you have to watch. Now, I understand it's slapstick comedy. It's Gene Wilder.
Yeah.
Right? So and Mel Brooks. So don't go, oh, I'm going to go watch Young Frankenstein. It's going to be a Frankenstein horror movie, right? No, that's not it. It's a spoof on Frankenstein. And it's comedic genius at its best. It's back in the day, right, where comedians had to be funny without being vulgar.
That is true. That's right.
And they didn't have, and the movies don't have special effects and all that. So to make a funny movie that was that well done in a time where you had no special effects, no sex on television, no vulgarity, because that was the rules back then, is absolutely genius work by Gene Wilder and Mel Brooks. So if you haven't watched it, if you're younger watching our stream, you probably won't like it. But I'd certainly encourage you to go see what comedic genius really looks like.
I'm going to watch it again this weekend.
There you go.
I'm going to do it.
All right. Wrap up the show for today. Thank y'all so much for joining us. Be sure and hit that like button. Like I said before, it certainly helps us out a lot, and we certainly appreciate it. I was told that my threat to put things behind paywall wasn't really a good threat, so I'll have to come up with something else to threaten you with. I don't know what that will be. Yeah, we're going to give you bad jokes. We're going to do dad jokes every day.
Oh, no.
So hit that like button. All right. We'll be back tomorrow, of course, for Wednesday. Danny Ratliff will join me, and we'll see you then. Have a great day.